When it comes to investing, the world of funds can feel like a giant menu with way too many choices. Here's a breakdown of the major types so you know what each one exactly serves up. Index funds. Index funds are designed to replicate the performance of a specific market index. For example, an S&P 500 index fund holds shares of the companies in that index, matching their weight. The goal is not to beat the market, but to mirror its returns. These funds are known for their low management fees, as they require minimal trading activity. Over time, cost savings compound into significant advantages for long-term investors. Index funds also provide instant diversification, since buying one means exposure to hundreds of companies. While returns rise and fall with the market, they eliminate the risk of underperformance caused by poor stock picking. For investors seeking simple, low-cost, and reliable growth, index funds remain one of the most effective tools. Mutual funds. Mutual funds pool money from many investors to buy a portfolio of stocks, bonds, or a combination of both. They are actively managed by professionals who research companies and adjust holdings in an attempt to outperform the market. This management comes at a cost, with fees often averaging around 1% annually, and sometimes additional sales charges or hidden expenses. These costs reduce long-term returns substantially. Another drawback is that studies consistently show many actively managed funds underperform simple index funds over time. Still, mutual funds can offer advantages such as professional oversight and easy diversification. They also provide access to specialized strategies, such as growth funds or bond-focused funds, without requiring investors to pick individual securities. For those willing to pay higher fees, mutual funds can be a convenient, though often average-performing investment option. Hedge funds. Hedge funds are private investment partnerships that use advanced strategies to generate returns. They are generally open only to accredited or wealthy investors, often requiring a minimum investment of $1 million or more. Hedge fund managers employ tools like leverage, derivatives, and short selling to profit in both rising and falling markets. The fee structure is notably high, often called 2 and 20, which means 2% management fees plus 20% of profits. While some hedge funds have delivered spectacular gains, many fail to consistently outperform broad market indexes over the long run. Additionally, hedge funds often restrict withdrawals, locking up investor money for extended periods. These characteristics make them both risky and inaccessible for most individuals. Despite their reputation, hedge funds are not guaranteed to deliver superior performance and often involve considerable costs. ETFs. Exchange-traded funds, or ETFs, are funds that trade on stock exchanges like individual shares. Most ETFs track a market index, similar to index funds, providing broad exposure to stocks, bonds, or other assets. Unlike mutual funds, ETFs trade throughout the day, allowing investors to buy and sell at current market prices. They are popular for their low costs, with some charging only a few dollars annually on an investment of $10,000. ETFs also offer tax efficiency because of the way they handle share redemptions, which helps investors keep more of their gains. The variety of ETFs available is vast, covering sectors, regions, commodities, and even specific investment themes. Their flexibility is both a strength and a risk, as frequent trading can reduce returns. When used wisely, ETFs provide low-cost, diversified, and accessible investment options. Target date funds. Target date funds are structured to adjust automatically as an investor approaches a chosen retirement year. For example, if an investor selects a fund labeled 2050, the portfolio starts with a higher allocation to stocks for growth. Over time, it gradually shifts toward bonds and other conservative investments to reduce risk as retirement nears. This automatic adjustment eliminates the need for investors to rebalance their portfolios manually. However, not all target date funds are built the same. Two funds with the same year can differ in their allocation strategies and fee levels. Investors need to review the specific glide path and costs of the fund they select. Despite these differences, target date funds remain popular for retirement planning, offering simplicity and a hands-off way to maintain an age-appropriate investment strategy. Bond funds. Bond funds invest pooled money into fixed income securities, such as government bonds, municipal bonds, or corporate bonds. These funds provide regular interest payments, which makes them attractive to investors seeking income rather than growth. They are often used to reduce overall portfolio volatility, since bonds typically fluctuate less than stocks. However, bond funds are not free of risk. Rising interest rates can reduce bond prices, inflation erodes the value of fixed payments, and corporate defaults can affect returns. Long-term performance also tends to lag behind stocks, making them less suitable for aggressive growth. Despite these limitations, bond funds serve an important role in providing diversification and stability within a portfolio. For retirees or conservative investors, bond funds are a useful way to generate consistent income while reducing exposure to stock market swings. Money market funds. Money market funds are short-term investment vehicles that hold highly liquid and low-risk securities. These include treasury bills, certificates of deposit, and commercial paper issued by reputable institutions. The primary goal is the safety of principal and quick access to cash, making them a common place to store emergency funds or short-term savings. Yields are generally modest, only slightly higher than a savings account, but they offer greater security compared to stocks or bonds. Money market funds are often used as a temporary holding place for funds, while investors decide on long-term allocations. They are not designed for growth, but they provide stability and liquidity. While not risk-free, as extreme market conditions can occasionally affect them, money market funds remain one of the safest and most predictable options available to investors. Real estate investment trusts, REITs. Real estate investment trusts, commonly called REITs, allow investors to participate in income-generating real estate without owning property directly. These funds pool money to purchase and manage assets like shopping centers, office buildings, hotels, or apartments. By law, REITs must distribute the majority of their profits as dividends, making them attractive for income-focused investors. With relatively small investments, individuals can gain access to commercial real estate markets that typically require millions of dollars to enter. However, REIT performance can be volatile as it depends on factors like occupancy rates, interest rates, and economic cycles. They can also carry sector-specific risks, such as downturns in retail or hospitality. Still, REITs offer portfolio diversification and a steady stream of dividends, making them a practical way for investors to access real estate exposure without direct property ownership. Commodity funds. Commodity funds give investors exposure to raw materials such as gold, silver, oil, natural gas, or agricultural products. These funds may hold physical commodities or use futures contracts to track prices. Commodities often behave differently from stocks and bonds, providing a hedge against inflation or market downturns. For example, when traditional markets struggle, commodities like gold may rise in value. However, commodity funds are known for volatility, as prices can swing sharply due to supply disruptions, geopolitical tensions, or demand changes. Investors should treat commodity funds as a diversification tool rather than a primary holding. They are available in both mutual fund and ETF formats, offering accessibility to retail investors. A small allocation to commodities can strengthen a portfolio by reducing reliance on stocks and bonds, though excessive exposure increases the risk of unstable returns. Balanced funds. Balanced funds invest in a mix of stocks and bonds within one portfolio. The goal is to provide growth through equities while offering stability from bonds. The exact allocation varies between funds, with some leaning more heavily on stocks for higher returns, while others focus on bonds for safety. Balanced funds are simple to use, since they give investors instant diversification without needing multiple accounts or complex strategies. However, the fixed ratio of stocks to bonds can limit flexibility. Investors cannot easily adjust risk levels without switching to another fund. Despite this limitation, balanced funds remain a popular option for people who want an all-in-one solution that provides both growth and income. They are often used in retirement accounts or by individuals who prefer straightforward, diversified investments with moderate risk. Sector funds. Sector funds focus investment in a single industry or market segment, such as technology, healthcare, energy, or financial services. They allow investors to capitalize on specific trends or industries they believe will outperform the broader market. The potential rewards are significant if the chosen sector grows rapidly. However, concentrating in one sector also increases risk, since performance depends on a narrow group of companies. If that sector struggles, losses can be severe. Unlike diversified index funds, sector funds provide limited protection against downturns in their targeted industries. For this reason, they are often used as a complement to a diversified portfolio rather than as a core holding. Sector funds give investors a way to express convictions about certain industries, but they require careful timing and risk management to avoid major setbacks. International funds. International funds invest in companies based outside the investor's home country. These funds offer access to developed markets like Europe and Japan, as well as emerging markets in Asia, Africa, and Latin America. Diversification is a key advantage, since economies across the world do not always move in the same direction. International funds provide growth opportunities when domestic markets slow, but they also introduce additional risks. Currency fluctuations, political instability, and lower regulatory standards can all impact performance. Fees may be slightly higher compared to domestic funds due to added complexity. Despite these challenges, international funds remain a valuable way to broaden a portfolio and capture global opportunities. Long-term investors often include them to reduce dependence on a single economy and to benefit from growth trends occurring in other regions. Fund of funds. A fund of funds is an investment vehicle that invests in other mutual funds, ETFs, or hedge funds rather than directly in securities. This structure provides investors with instant diversification across multiple asset classes and strategies. With one purchase, an investor can gain exposure to equities, bonds, international markets, and alternative assets. This convenience makes them appealing for retirement accounts or individuals seeking a hands-off approach. However, a key drawback is the layering of fees. Investors pay both the management fee of the parent fund and the expenses of the underlying funds. This double cost can reduce overall returns. There is also the risk of overlapping holdings, which limits true diversification. Despite these issues, fund of funds can be a suitable option for investors prioritizing simplicity and broad exposure over maximum efficiency. Index-based ETFs versus active ETFs. Most ETFs are passive, tracking a specific index and offering broad exposure at very low cost. Index-based ETFs require little management and are designed to mirror market performance. Active ETFs, on the other hand, are overseen by portfolio managers who make buy and sell decisions in pursuit of higher returns. Active ETFs typically charge higher fees than passive ones, though still lower than most mutual funds. Their performance varies, with some outperforming benchmarks, but many failing to deliver consistent results. Investors choosing between the two should weigh cost against the desire for active oversight. Passive ETFs are generally more predictable and cost-effective, while active ETFs provide flexibility and the possibility of outperformance. The choice depends on whether the investor values simplicity and cost savings or professional judgment and strategy. Target risk funds. Target risk funds are designed to match a specific level of risk chosen by the investor. They come in categories such as conservative, moderate, or aggressive. A conservative fund invests heavily in bonds to prioritize stability. A moderate fund balances stocks and bonds, and an aggressive fund emphasizes stocks for higher potential returns. Unlike target date funds, which gradually shift over time, target risk funds remain at the same allocation unless the investor switches. This makes them easy to understand and align with personal risk tolerance. However, investor needs may change with age or financial goals, requiring adjustments. Target risk funds are commonly used by individuals who want a simple, single fund solution that reflects their comfort with risk. They provide clear choices for aligning investment strategy with personal financial objectives.